the sheet was in order, but the sign-up sheet was actually the open sheet. I think we used the same. I'll be quick. Thank you, Lauren. Hey, just to let everyone know that the LABA conference is coming up. It's going to be February 24th. And thank you. We're organizing with Columbia Business School, and we're bringing experts. I'm sorry. So we're bringing experts on Latin America, leaders from the region, and they're going to talk about a bunch of topics, macroeconomics, entrepreneurship, fintech. It's also going to be a good opportunity to network with the speakers. And we're going to have breakfast, lunch, and a cocktail reception. And tickets are RSVP on campus groups, and tickets are, you can purchase your tickets there as well. And $35 for LABA members and $65 for non-members.
Thank you. So should I ask the two questions again? Last time, no more, why not? Who's not in a group yet? Okay. Who's not picked a company yet? Come on. Be honest with yourselves at least. Okay. That's good though. We're starting to narrow down the numbers. So I'll try to get the two people who are not in a group, email me after. Let's see if I can find you a group, because it's clearly the adoption process is not working smoothly. Okay? So we'll do that and pick your company. Okay? So today we're going to complete the last leg of talking about the objective in corporate finance. For those of you who came into this class expecting a lot of numbers, you're probably saying, when are the numbers coming? But guess what? Without this foundation, the numbers really don't matter. So this is about looking at why people make the decisions that they do. So if you remember the last class, I in a sense shredded all of the assumptions I needed to maximize stock prices as an objective. I said stockholders have little power over managers, and managers put their interests over stockholder interests. We talked about green mail and golden parachutes and acquisitions. We talked about how lenders, they lend money to a firm and don't protect themselves, get ripped off. Whether you are a big company, a small company, a reputable company or not, if you lend money to that company and you don't protect yourself, you're asking for trouble. We talked about how managers sometimes lie to markets, but more commonly hold back information, delay information, try to manage the flow of information. And we also talked about the fact that in the world that we live in, there are social costs, there are social benefits, they're all over the place, but they're actually very difficult to get your hands around. So this is the world we live in. And in this world, if you ask companies to go out and maximize stock prices, bad things can happen, right? Like what? Like you can have accounting scandals where you cook the books to make your stock price go up. You can have cases like the Nabisco case where you rip off bondholders to make stockholders better off. You can have cases where companies dump, billions of dollars, create billions of dollars of social costs and in the process increase it. Every scandal is embedded somewhere in one of these conflicts, right? So we're in a really bad place now because in a sense, it looks like maximizing stock prices is not going to work because this looks like a more realistic picture than the utopian picture I painted for you. Now, there's this, so if you think about the pieces that are driving us there, the first is that managers act in their self-interest. They're human beings, and their self-interest often dominates stockholder self-interest. Lots of people lend money to the firm. They don't protect themselves. They get exposed to what we talked about with the Nabisco story. Markets are not always efficient and cool. That trading room is not full of polite intellectuals. It's full of people who are making decisions in a hurry, often based on very incomplete information, if you can even call it information. And finally, there are large social costs. So this stage, here's the question we face. What do we do now? And here are the three choices we face. One is we can pick a different way of doing corporate governance. Let me explain. You have all these publicly traded companies run by managers, right? In the world that I described up till now, the responsibility for keeping those managers in place lies with stockholders. If you don't like the way a company is run, you have to take the role of changing the management as stockholders. Maybe that doesn't work. Maybe stockholders are not the right people to keep an eye on managers. Maybe there's a different corporate governance mechanism. I'll describe a few that have evolved, and you can decide whether one of those is more appealing than the stockholder-based maximization system we talked about. The second is maybe we can pick a different objective, a better objective, maximize revenue growth, maximize market share, maximize number of users, maximize number of downloads. The list goes on. I could focus on something very different from stock prices, and maybe that won't have the side costs that stock prices have. Or I can go back to maximizing stock prices as an objective and try to fix the problems we talked about as best as we can. I'll give away my biases. Everything I know about corporate finance is built on the presumption of maximizing value. So my bias is to take you to the third choice, because then I can keep going through the rest of this class saying, hey, you know what? It's not a perfect objective, but it's the best of what we have. So that's my bias, but I'm going to try to be as open as I can with the other two choices and let you decide. And if you decide on one of the other two paths, recognize that as we go through this class, you're going to have disagreements with me, not about the methods and metrics I'm using, but with the underlying objective, where we're going. So let's start with the first of those choices, a different corporate governance mechanism. If you go back to 1945, end of the Second World War, Germany and Japan, as economies, were in complete shambles. There was nothing there. And over the next 40 years, in true economic miracles, they built themselves back up to becoming the second and third largest economies in the world by the middle of the 1980s. This is not a history class. But the way they built themselves up was a very different corporate governance system than the one in the US. Let's take Japan. Japan are what are called kairitsos, which are companies held together by cross-holding. So basically you'd have 60 or 70 companies in a group, all of whom held shares in each other. And the way Japanese corporate governance worked was if one of those companies was badly managed and badly run, the remaining 59 managers would get together and replace the manager of the 60th company. Stockholders had no role to play in it. So that's the Japanese system. And the Japanese system was imitated by Koreans with the chaebol system. So in Asia, you saw that cross-holding system come in, where essentially stockholders had little power, but managers essentially took care of their own. Germany had a similar system, but it had with one small difference. Deutsche was the largest single stockholder in Daimler. Daimler was the largest single stockholder in Allianz was the largest single stockholder in Deutsche. There was always a bank in the middle, whether it was Deutsche or Dresdner. You had a bank in the middle, but you had a cross-holding structure around the bank. And again, managers kept an eye on each other. Stockholders didn't play a role. You see that, by the mid-80s, it looked like those systems had done a much more efficient job of keeping managers in line than what you had in the US with all these hostile takeovers and activist investors. So you can't blame Michael Porter in the mid-1980s for saying what was wrong with the US corporate governance system was it wasn't more like the Japanese system. In fact, he suggested that the US stop paying attention to shareholders and create a cross-holding culture, just like in Japan, and let managers take care of their own. It sounded really good in 86 or 87 or 88 when he came up with that idea. But then in the 1990s, you saw the downside of these cross-holding systems. Remember the example that I just gave you? You had 60 companies, and one of them was badly managed and badly run. The remaining 59 got together and replaced the 60th manager. Let me change the facts a little bit. Let's assume you have 60 companies in a cross-holding culture, and 59 have made bad real estate loans, and one company hasn't. Let me ask you a question. Who's going to replace whom? Is the one guy who did the right thing going to be able to replace the other 59? Or the 59 who did the wrong thing going to get together and say, what's wrong with you? You're not a team player. Where are your bad real estate loans? Get rid of that guy. Then surround the wagons, release as little information as you can about your and hope they go away. In 1992, Japanese banks and US banks had roughly the same amount of bad real estate loans on their portfolio. US banks were forced to deal with it, not because they wanted to, but because there was investor pressure saying, tell us how much you lost, tell us what loans are bad. They took their licks. Citi lost 30% of its value in 92. Bank of America was hurt badly. But they took their licks and they were able to move on. Japanese companies said, what bad real estate loans? And 25 years later, Japan is still paying the price for not dealing with its problems head on. In fact, if you think about what the Japanese and the German systems are doing, they're elitist systems, right? What are they saying? The shareholders of the unwashed masses, they didn't go to the right schools. They don't have the information and the intelligence and the right good sense to decide who's a good manager, who's a bad manager. We're the managers. We know what's happening. We will make the right decisions for you. That's the elitist system. In fact, in Japan, the Ministry of Finance was at the center of the economy. They made the big decision. They had the brightest people in Japan working there. You know what the problem with elitist systems is? Elitists. Because they went to the right schools. They're used to being right. So when they're wrong, what do? They act like they're still right. The problem with elitist systems is when they make a mistake. And you can think around the world about elitist systems that get us into wars. Every single big mistake that lasts a long time, it's usually because 5 really smart people got together somewhere and said, hey, this is probably going to work. And when it stops working, their egos get in the way of admitting to mistakes. If you look at the German and Japanese systems, the Japanese system in particular paid a substantial price for essentially letting managers make the decisions on what to reveal and when to tell markets. In fact, you could argue that if you trace the German and Japanese system, you have other elitist systems that have come into being. China, for instance, right now, is an extremely elitist system in terms of how managers get replaced. It's not from the bottom up where shareholders say, hey, those managers are doing a bad job, we're going to replace them. It comes from the top down. There is a trade-off here. You will have less costs in terms of things like because democracy is always a messy process. And in this case, you could argue that by having a group of really bright people making decisions for you, you're avoiding those costs, but you have to think about the other side of the equation. When those people make a mistake, and those mistakes are systematic, it takes a long time to deal with those mistakes. So I'm not going to say these are bad systems. Clearly, they can work really well for long periods. The test of these systems is not when things are going well, it's when things are going badly. So the Chinese system is still to be tested. I think the process of testing has already started in the last couple of years. We will find out how resilient this system is, how it deals with mistakes. Does it do what the Japanese system did, which is surround the wagons, release as little information as possible, or does it deal with things frontally? And if it doesn't, then you're going to see the same problems that every one of these systems have had historically come into play again. So that's the first choice. Pick a different corporate governance system. And you can think of other countries, how they run their businesses and decide whether that's a more efficient way of dealing with bad managers than the stockholder-based system you see in the US. Here's the second choice. Maybe this maximized value is too broad. Maybe we need something more focused, something we can keep our eyes on. And if you've ever worked at a company and you look at those 5-year plans that many companies put together, many of them state those plans in terms of maximizing growth. We want to double our sales over the next 5 years, maximizing earnings. We want our margins to go up to 20%. Maximizing market share. We want to increase our market share from 8 to 20%. There's actually an advantage to having that focus, right? This is something you can focus on. You don't have to worry about what markets think about you. Just focus on increasing your market share. And God help you if you hire a consultant to come in to your company because they come in with acronyms. Maximize CFROI. You're saying, what's CFROI? We can't tell you. It's a secret sauce. But you need us to come in every 6 months and tell you what your CFROI. This is a great way to keep you coming back. So you get EVA, CFROI, crocky. That's Deutsche Bank's ill-fated attempt to come up with their own acronym. Yeah. Essentially, ways of saying, this maximizing value is so complicated. We'll give you something simpler, a magic bullet. Just focus on EVA, focus on CFROI. If you increase it, you're running a better company. And you can see why CEOs want to go towards one of these metrics. I don't have a problem with any of these metrics as long as you remember that they're intermediate metrics. You know what I mean by intermediate metrics? Maximizing market share by itself is an absolutely stupid objective. And here's why. Would you like 100% market share of the market you're in? Don't say yes until I tell you the second half. If I told you have to sell below cost, you can have 100% market share, but you're going to lose tons of money. Maximizing market share makes sense if you can use that market share to do what? Increase your pricing power, increase your margins, increase your profits, and eventually your value. Maximizing revenue growth is easy. Just go out, buy a second company, a big company, your revenue is pretty much doubled. But revenue growth creates value only if you buy it at a reasonable price. I'll tell you a story to show how much choosing one of these objectives can take you off course. 1981, American Airlines got a new CEO, a guy called Robert Crandall. In his first press conference, he stated his objective for American. He said, I want to make American the #1 domestic U.S. airline. #1 domestic U.S. airline. And by 1989, he'd succeeded. American was the #1 domestic U.S. airline in terms of passengers flown. But in 1989, there were only 2 airlines making money in the US. Neither was called American. One was Alaska Air, because I guess nobody else wanted to fly to Fairbanks. The other was the very young Southwest. And you know what they did? They flew from Houston to Dallas, Dallas to Houston, back and forth, back and forth. Not the most glamorous route in the world, but they said, we don't care about glamour, we're here to make money, we're a business. But you can see how once you make market share your objective, it percolates through the organization, right? I mean, you read about the Wells Fargo scandal where and if you think about where that started, somebody says, we want to make our bank accounts grow 7%. And that passes through and all your incentives are based on that. And guess what? You deliver, but it might not be good for your company, good for your value, good for your earnings, because you've lost sight of that end objective. So if somebody says, instead of maximizing value, can I maximize market share instead? You say, that's okay, as long as somebody's keeping an eye on the link between market share and value, because there are some businesses where the only way you can increase market share is by making yourself a less valuable company. And if that's the case, then maybe maximizing market share is not the right tactic or strategy for you. Which brings me back to maximizing stock price. I told you I'm biased to get back here. I'll tell you my strongest defense for why I still prefer a market-based system. It's not that markets don't make mistakes. They make horrible mistakes, just like any other system you pick. But my defense of markets is markets have no egos. When they make a mistake and they find out they've made a mistake, they correct their mistakes. You see this happening every time a stock drops 85%. What's the market saying? Hey, I screwed up. I'm going to knock off 80% or 85%. This time my ego is getting in the way. Let me do it gradually. Markets adjust quickly. So when you think about those 4 linkages, if you let them play out, every one of those linkages where we talked about the weaknesses, there is a built-in mechanism that allows for a counterforce. Let's take the first one. Stockholders have little power over managers, right? Managers take full advantage of them. If you let this process play out, there is actually a counterforce that kicks in that prevents this from getting out of hand. We talked about Nabisco and lenders, lending money to the firm and not being protected, how you get ripped off. We're going to talk about how with each of these linkages, if you let the process play out, and that's a big if, there is always a correction mechanism. So let's start with the first one. You're a stockholder in a company, I'm your manager. I said I put my interests over yours, right? So the first time I do it, what happens? You get pissed off. Then the second time I do it, you get even more pissed off. With every company, there's what I call a critical mass of piss off, where you decide, I'm not going to take this anymore. It's like that movie Network where a guy, Albert Finney opens the window, I'm not going to take this anymore. That's the point you reach when you get pissed off enough. And here's what happens when you hit that critical mass. You can't do much about it. You own only 1,000 shares, right? But there are other people who notice you're really pissed off and they try to take advantage of it. What am I talking about? You start to get some institutional investors wake up and say, we can't just vote with our feet anymore because every company we go into does the same thing. We're going to stand and fight. CalPERS, the California Pension Fund in the 1980s, was one of the first institutional investors to actually say, we can't just sell shares. We're a $100 billion fund. We can't just move from company to company just because they're not doing the right thing. We're going to stand and fight. It's unusual, but you will see some institutional investors step in and fight. The problem with many institutional investors, they have too many other fish in the fire. They can't go full-fledged into this fight. And into this void is where activist investors step in. We talked about Bill Ackman and Carl Icahn. And I said, these are not the nicest people in the world. I wouldn't want to eat dinner with Carl Icahn. I'd be afraid he'd eat me. Okay? But let's face it, we need Carl Icahns in the world to ask tough questions. And I also said Carl Icahn makes a lot of mistakes. He's not the deepest corporate finance thinker in the world. If you've noticed every Carl Icahn target, here's how it goes. He goes to the company and says, you have too much cash, give me the cash. You strip it down to basics. Go back and look at every single press release of companies he's targeted. That's what it boils down to. You have too much cash, give me the cash. You're saying, that's very crude. Why do the other stockholders go along with it? Remember, you're really, really, really pissed off at these managers. You don't want them holding your cash. So if somebody says, you have too much cash, give me the cash. You say, yay, give him the cash, because at least the cash will leave the company and come to us. The biggest strength you can have as an activist investor is to know which companies to target. That's Carl Icahn's strength. He can detect when investors are really pissed off at a company and jump into the fray. Because sometimes he makes mistakes. He did this in Motorola. It did not work because investors were not pissed off enough. He tried this at Apple. It didn't work because investors were not pissed off enough. He did it at Blockbuster. It worked because investors were really pissed off. But it happens because managers took advantage of investors year after year. They weren't willing to listen. The activist investors stepped in. And some of the stockholders start to become vocal. Not just at the annual meeting, but bringing up issues about the company and confronting the company. So what you effectively have is there's a point in this process where you get a backlash. And here's the ultimate backlash. You're a manager, you've taken advantage of your stockholders year after year after year. They're really pissed off at you. The ultimate way to get you back in line is a hostile acquisition. You see why? The essence of the word hostile is right after I take you over, I'm going to fire you. And it works only because investors in your company have given up on you. Because if you think about it, every hostile acquisition is a fight between two sides, right? On the one side are the managers, on the other side is a hostile acquirer. For once in your life, you as the shareholders are right in the middle. So there's been a hostile acquisition attempt. You as managers, what do you tell stockholders? Don't sell to that hostile acquirer. He's going to ruin the company, right? And what do you as a hostile acquirer tell the stockholders? Don't trust those managers, they don't care about you. For once you get to decide who to trust. And now you can see how past performance, how you've been treated in the past by managers is going to come into play. The typical target firm in a hostile acquisition is a badly managed, badly run firm. And I'm just not making that up. You can actually look at the returns on equity of firms in hostile, which are targets in hostile acquisitions versus the rest of the firms in the sector. They earn about 3 to 5% less in return on equity. You look at the stock price performance of target firms in hostile acquisitions versus the rest of the sector. They've underperformed the rest of the sector. And in most target firms, managers own very little stock. They don't behave like stockholders, they behave like managers. So the next time you see the target company in a hostile acquisition whine about being the target, remember, most of the time, they brought it on themselves. This didn't happen accidentally. It's years in the making, finally coming to fruition in a hostile acquisition. That's the process that kicks in when you're allowed to kick in. The reason I say when you're allowed to kick in, do you know that in half the markets in the world, hostile acquisitions are banned? You can't even do a hostile acquisition. It's not allowed. It's viewed as a bad thing. In fact, there are states in the US where hostile acquisitions have been banned over time. Pennsylvania actually passed a law to protect one company in the state from being taken over in a hostile. They passed a law against any Pennsylvania company being ever targeted in a hostile acquisition. So can they do that? Hey, you can go in and change corporate law. And when you do that, what have you done? When the people who pass the law do it, why? Because they want to protect good companies. They've been watching too many movies. They think every company is a good company. The hostile acquirer is the bad guy, is going to ruin the company. You've got to protect good. But the reality is for every good company you protect, there are 9 bad companies that you now let go under the radar. Yes?
What was the company?
Armstrong, I think it was the name of the company, Armstrong Tires. I can get you actually, that's from the 1980s. Okay. I think it's called Armstrong Tires. A Canadian company was trying to take it over, and this was actually an attempt to stop the hostile acquisition from going through. It's one of the most studied cases of all time because what people could then observe is how the market treated other Pennsylvania companies after the law was passed. And guess what happened collectively to the stock price of Pennsylvania companies in the 45 days after the law was passed? They dropped about 6% because investors looked at these companies saying, if this company is badly managed, there's nothing I'm going to be able to do about this. You've taken away the biggest threat that we could use to keep managers in line. But it's, and there were other states that tried to do this through the 1980s, but with Delaware being 2/3 of the companies, it's not had the impact that Delaware would have. If Delaware passed a law like this, you're going to see a monstrous impact in the market because you're going to see 2/3 of the market being impacted. Any other questions? And finally, as nothing happens by accident. So when you see this pressure build up on companies, either from activist investors or from hostile takeover, that's when you see boards start to change. In what ways? Well, in response to this activism, you start to see that boards have become smaller over time. Remember the Disney board of 17? That started to shrink. It's more like 10. In fact, Disney's board right now is only 12 members, but that's actually a trend you're seeing across companies. Second, with or without Sarbanes-Oxley, I think would have happened, but with Sarbanes-Oxley, you have far fewer insiders on the board. Those 7 people who worked at Disney, that's no longer typical in boards. Directors are increasingly compensated with stock rather than with cash because they want directors to think like stockholders. I have a problem with the way they get the stock. I would much rather that they be given the cash and buy the stock. You say, well, it's just one step. There's actually behavioral evidence that suggests that when somebody's offered in kind, it doesn't feel the same way as being given the cash and being asked to buy it because it that act of buying makes you think more like a stock. But at least they're starting to hold some shares. And finally, in more and more companies, rather than the CEO picking the people sitting on the board, you're starting to see a nominating committee. All good trends, but all trends in terms of on the surface. Because these are making boards look more independent, but the ultimate test of an independent board is whether you can say no to the top management, and in that count, you're not seeing a lot of change, but at least you're moving in the right direction. So let me complete the Disney story. Remember in 1998, Disney was, Michael Eisner was the CEO of Disney, imperial CEO, complete power over the company, a board of directors that was a complete rubber stamp. By 2003, Eisner was starting to piss off a lot of people. In fact, every year Disney kept moving its annual meeting to a smaller and smaller forum because it was getting so unpleasant. And I was convinced if this trend continued, one year their annual meeting would be in a restroom in Kansas City, where only 2 people could fit in the room and one would be Michael Eisner. But clearly investors were getting pissed off. In fact, remember Roy Disney, the only person on that list of big stockholders in Disney who I said worked for Disney? In 2003, he actually resigned from the Disney board. And he resigned with a guy called Stanley Gold, who was another investor in the board. And they both said they were resigning because Michael Eisner was not consulting the board. So things were coming to fruition. And finally, to kind of top it off, in 2004, Comcast decided to make a hostile acquisition bid for Disney. It was the most insulting hostile acquisition bid ever made. And here's why. Normally, when you do a hostile acquisition bid for a company, what you do is you take the market price and you offer a premium, right? Comcast took Disney and offered a discount. They said, your stockholders are so pissed off with you, they will actually sell the shares at a discount just to get you out of the way. It didn't work. But the message had been delivered. Comcast wanted to deliver a message to Disney, which is, we don't think much of you guys. And Eisner woke up. The board woke up, actually. The board said, hey, you are very unpopular. We can't defend you anymore. The rubber stamp board is waking up. Okay? So in 2003, Eisner did a formal restructuring of the board, taking his personal attorney off, the people who are the most egregious examples. He also stepped down as, remember his chair of the board? He stepped down and made George Mitchell the chairman of the board. He said, it's not right being chairman and CEO. Well, finally you found out. And he passed a new set of corporate governance principles. This is now part of almost every company, especially outside the US. You open up a company's annual report, there'll be this corporate finance principles. Look how good we are. Right? So basically, this listed out, say, hey, I'm not going to have, you can go through all of the different terms in here, but essentially it was saying, this is not going to be a rubber stamp board anymore because I feel the pressure. Managers left to themselves will never do it, but when they feel the pressure, they start to do it. I have to tell you, it didn't quite work because in 2005, Eisner left. He was actually fired. That rubber stamp board actually said, you got to go. But it happened because the pressure built up in the company. And in 2005, he was replaced by a guy called Bob Iger. Right? And Bob Iger was the anti-Eisner. He was actually the exact opposite of Eisner. Small ego, kind of didn't care who got the credit. He came in and he restructured the board. And in 2008, if you looked at the board, it was both smaller, more independent. And Disney started to rise up the rankings in terms of corporate governance. It went from having the worst corporate governance in the entertainment sector to having the best. The company started doing well. Iger seemed to be listening to shareholders. Annual meetings became listening posts. We actually listen. This is all good, right? But that was 2005 he became CEO, 2008, 2009, 2010. In fact, in 2011, Iger told the board that he was interested in leaving and he wanted to train somebody or get somebody ready to... This is all good, right? That's what CEOs are supposed to do, not be CEOs for life. He said, you should get a replacement ready for me because I'm not that important to Disney. Disney is about more than me. I'm just a person. You can find a CEO to run the company. And this is when things start to get interesting. The longer a CEO stays in a company, the more the board becomes that CEO's creature, right? So this is 6 years into Iger's. So by 2011, Iger says he's leaving. This is the peak of Disney's corporate governance power. You're looking like a really good company, but the board's starting to become more compliant. In fact, they went to Iger and they said, and this was when he was supposed to retire in 2013. He said, instead of retiring, can you stay on a couple more years? You're too important for Disney to leave the company. His reaction was the same thing that Julius Caesar had when he was offered the crown. Remember this Shakespeare thing? Offered the crown. No, I'm not that important. Second time, no, I'm not that important. Third time, okay, I'll put it on. Right? So after they asked him about 2 or 3 or 4 times, finally he said, you know what? I'm that important. I'll stay on. It's a fateful decision. Because if you think about it, when he announced he was going to retire, there was a whole set of managers below him who had lined up expecting to move up. So now he said, I'm going to stay on. And his successor, at least his rumored successor, Tom Staggs, was being groomed to be the CEO in 2016. And it was a complete surprise to Wall Street that he was leaving. The board said that there were things that they didn't agree. It was very, very diffuse as to what exactly happened. But it looked like he'd been pushed out. And the problem was when he got pushed out, there was nobody at Disney who was in a position to step in. I sent you that news story from yesterday. What did it say? The board is pressuring Iger to stay on. This is what happens when you start to let the CEO continue and continue and continue, is you get more entrenched. The more entrenched you get, the less the board will challenge you. And the more entrenched you get, the less likely it is that you're going to have people below you ready to step in, because they're saying, I could be here for the next 20 years. I'm moving to another place where I can actually move up the ranks. There are consequences. Maybe we need term limits for CEOs. It sounds like an extreme. Maybe we should, 10 years. It doesn't have to be 4 years like a presidential term. How about 10 years? That's long enough to be CEO. Because I think the longer you stay on as CEO, the more entrenched you get. And the more entrenched you get, the more difficult it becomes for the board to ask you tough questions. So to me, that's the cautionary tale out of the Disney story, is you got a great CEO. CEOs seem to listen to stockholders who seem to not care about acquiring power. But the longer he stayed in there, the more he starts to behave like an imperial CEO. Now I talked about Sarbanes-Oxley. After the 2001 and 2002, there are lots of scandals going on, especially corporate governance scandals. Enron, for instance, it turned out that Enron had 29 directors. And half of them were at least 5,000 miles away from Houston. So basically, when the company was created, basically the directors were picked in such a way that nobody would come back for a board meeting. It was too far away. So Sarbanes-Oxley was passed primarily because they felt we need to improve corporate governance at companies. And in fact, lots of countries have passed laws trying to improve corporate governance. Now, are there things you can do to improve corporate? Absolutely. I think you should make annual meetings more open. I think we need to change the rules on proxies. There are lots of small things we can do. But in my view, corporate governance can never be legislated. You cannot legislate good corporate governance for the same reasons you cannot legislate a good democracy. Can you imagine passing a law saying only good governments can get elected, only informed people will be allowed to vote? You can pass all the laws you want, but ultimately you get the government you deserve. The same thing happens with corporate governance. You get the managers you deserve. So while we all bitch and moan about how horrible managers are, ultimately, if you're a stockholder, the finger's pointing back at you saying, what are you doing about it? Because if stockholders remain passive, no law is going to protect you. And if you're active, you don't need a law. You can actually push up. So that's really all that governance should be able to do, is to allow people who are pissed off, to actually push up, to be able to be heard. Because if you can create a forum, that's all you can hope for. Now, one of the things about corporate governance is it's often oversold. So you go to one of those corporate governance services, they say good corporate governance translates into higher stock prices. Very loosely speaking, that is true. There's actually some very weak evidence, and I'll confess that if you have stronger corporate governance, you trade at a higher price. And I'll tell you how these studies are done. They take a corporate governance score. So the most famous of these studies looked at about 3,000 companies, where they'd scored the company on how independent is your board, how big is your board. They came up with a corporate governance score. Then they looked at what multiple of book value these companies traded at. So they looked to see if your corporate governance score is higher, you trade at a higher price to book ratio or a higher price earnings ratio. And based on that study, they concluded if your corporate governance is stronger, then you trade at a higher price. The reason I say it's weak is the R squared is like 8%. So there's a lot of noise in there. And let me put it differently. I know of lots of very well managed, very well run firms that have horrible corporate governance. Take Google, right? I think we'd all agree it's a company that's incredibly profitable and well-run. Awful corporate governance. Facebook, awful corporate governance. And you can have companies where corporate governance is really good and the company can be really bad. There's no guarantee that good corporate governance is going to deliver good management. Why? For the same reason, there's no guarantee that a good democracy is going to deliver a good government. You get the right to make your mistakes. The one thing that good corporate governance offers you is if you make a mistake, you get a chance to fix that mistake. That's all I can offer you. So don't oversell corporate governance. This is not overnight going to make a bad company into a good company. But it is essentially going to open the door for at least making the changes over time to get back on a path you should be getting back on. So that's the backlash when you think about the stockholder-manager, and you can see how the process plays out. Now let's talk about, let's talk about lenders. We talked about the Nabisco case, and we talked about how when lenders lent to Nabisco, bondholders bought bonds in Nabisco, they left themselves unprotected. And because they left themselves unprotected, when Nabisco did the leveraged buyout, they lost 20% of their value. There's nothing they could do about it. But after Nabisco, in fact, before you think that these are all naive small bondholders living in Florida who lost money, you know who the biggest loser on the Nabisco bond fiasco was? It was Deutsche Bank, which is actually one of the biggest holders of Nabisco bonds. So it wasn't just small investors. Everybody did this. But people learned. After the Nabisco fiasco, you saw more bonds became puttable. We talked about how you put your bonds back. We saw more bonds become convertible. How does that help you? Basically, if you do a leveraged buyout and you try to make equity investors much better off, you know what I do as a bondholder? I become one of you. So who are you going to rip off now? Because with a convertible bond, I can convert to equity. So it's a defense mechanism you're offering lenders saying, if I really screw you over, come over and you can become one of us. And you also started to see special features put into bonds to protect some bondholders. I'll give you one example. Merrill Lynch in the late 1980s created what were called rating-sensitive bonds. Now here's how it works. Normally when you buy a bond, you know the rating today, you set an interest rate based on the rating, and you're stuck with that, right? And you saw how badly that served you with the Nabisco case. With a rating-sensitive bond, the coupon rate is set up front based on what your rating is today. But guess what I do next year? I check your rating next year, and if your rating drops, I adjust the coupon rate. So if you did a leverage buyout like Nabisco did, the interest rate, instead of being 6%, would become 12%, saying, hey, you changed the rules of the game. You made yourself a riskier company. I'm going to demand a higher interest rate. Again, all of this happened after the Nabisco loss, but you can see how bond markets learn. It takes them a while, but they learn, they adapt, they adjust both lending and bond offerings to what they've learned from the last crisis, mistake, whatever it is. So again, if you let this process play out, it will play out. You'll see the correction, the bond market will. Again, it's not perfect because you still will get crises and mistakes and you still will take time to get out of them, but it's a way in which you get the correction in the marketplace. Let's talk about financial markets. We talked about how companies delay news, sometimes lie to markets. Eventually, the truth comes out. It's not, it's going to come out 1 year. And when the truth comes out about your company, bad things happen, right? First, your stock price drops. That's a given. So you have an accounting scandal. You say, you know what? We made only half the money we claimed we made. The stock price drops. That's a first level punishment. The market saying, hey, you're not worth as much because you don't make as much. You know what the second level punishment is? And this happens to every company that's in a scandal. Your stock price goes down, and I stop trusting you. You say, who cares about trust? Remember when the financial balance sheet, we divided the assets of a company into assets in place, investments you've already made, and growth assets. What do growth assets rest on? Expectations, perception, right? If you're a company that lies to me about your past earnings, and I look at your growth assets and say, well, I can't trust these guys. Maybe they're lying to me about future projects. I'm going to say something very strange. I can understand why a mature company's managers might commit accounting fraud. I don't condone it, so let me be very clear. I can understand them doing it. I cannot understand why a growth company would want to even try playing this game? Why do you want to make your earnings per share last year look 7 cents higher than it really is when 80% of your value is from expectations of the future? You're risking way too much. That's why I couldn't for a moment understand why Groupon was run the way it was all through its life. This is a company that came into an IPO trying to commit fraud. Essentially cooking the books. Saying, hey, you know what? Those customer development costs are really not expenses, they're capital expenses. There's a case to be made here, but they did this time after time after time. They basically wanted to make their earnings from the last 12 months look positive instead of negative. And my reaction was, who cares what you made as earnings last year when 90% of your value is coming from the future? If you're a tech company in a young tech, if I were advising Snap or or Facebook or Twitter, my advice is be open about your financials. Don't play any accounting games. If you have to, bend over backwards to be as open and transparent as you can, because you have too much to lose in terms of investors losing faith in you and those growth assets dissipating. So let the market again play itself out, and you'll get corrections on both sides. Companies will learn that the consequences of lying are not just a one-time drop, but a long-term effect. As Valiant is discovering for year after its supposed scandal, it's still having trouble picking itself up off the ground. And investors will learn. Why? Because if I keep bailing you out every time one of these things happens, say, poor you should know that was fraud, you should be protected against it, you have no incentive to do your own homework. And there might be things, you could read the tea leaves and say, maybe I should be looking at that. There's a whole area in accounting called forensic accounting. It's actually a lot more fun than regular accounting. It's about going through financial statements, looking for clues that people are not telling you the truth. There's lots of places in financial statements where you put stuff in, where if I'm careful in reading it and say, you know what, I shouldn't be trusting those earnings. And that came about because investors said, we have to watch out for ourselves because nobody else is going to watch out for us. So that's what happens when you lie to markets. That's the counter effect. So let's talk about society. Let's say you're a company that constantly wanders to the edge of what's legal and perhaps even wanders over. In other words, you consistently violate societal norms. You're viewed as a bad corporate citizen. Think about the consequences, right? First, you're going to see, investors who own stock in your company feel pressure to get rid of your stock. Whether you're in an endowment fund, get rid of that company, it's a bad company. Okay? You're going to see employees leaving who don't want to hang out with you because you're viewed as a bad corporate citizen. And at some point in time, your reputation is going to start to affect your operations. In some businesses, the effect is immediate and drastic, especially retailing. The minute, I remember when the Gap was on 60 Minutes for you, there was a 60 Minutes episode where they filmed Gap factories where they were using underage labor. Next day, the stock price drops 12%. The Gap has to come out with this massive statement because there the consequences were economic and immediate. In my view, if you want companies to be good corporate citizens, you've got to make it in their best economic interest to be good corporate citizens. They're not going to do it because you lecture them. And this is where there are consequences. If you're a bad corporate citizen, I believe there are consequences for your operations, for your revenues, there are profits. More in some businesses than others. Let's face it, if you're a discount retailer, you probably care less than if you're a specialty retailer. Because the customers who buy from you might not be as affected by those stories. And this is why I think it makes sense to not walk all the way to the line. Remember that guy Martin Shkreli? He's a lunatic, right? He does a constant stream YouTube. I don't think he ever goes off YouTube. And he did an incredible disservice to me. He actually decided to use my site as one of his sources, and he talked about corporate finance and that what he was doing came from my class. This is not good advertising for me. So let me be very clear. What Martin Shkreli was doing was not good corporate finance. Because if those of you who never heard of him, he's the guy who took a pill which was selling at $13.50 and made it $700 because it catered to a small market. And he said, if I can charge it, why shouldn't I maximize? He missed the point about maximizing value. If you want to run a pharmaceutical company, this is a one-time game. Yeah, raise it to 700, you're going to make a lot more money on this pill. But if you realize that you're a pharmaceutical company, you got to go back and get FDA approval, you got to go back to the market, you got to deal with the government in the future. This is the most regulated business now in the country in terms of interaction. Half your sales could come from Medicaid and Medicare, right? You can't do this. But that's what often happens when people take those, they view maximizing earnings next year as the equivalent of maximizing value. So let me be very clear. Maximizing value is not just about earnings in the next quarter, the next year. It's about maximizing the value of your business. If you do it right, there are lots of things you could get away with doing legally, but will not make sense for you from the perspective of increasing your value as a company. So let me summarize. My biggest pitch then for maximizing prices is that it's self-correcting. Yes, go ahead.
Regarding the societal,
right.
Is this only referred to the firm as a whole, or does this include what like the manager and CEO does?
That's a good question. Here again, you could argue that maybe the company will suffer, but the CEO collects his bonuses and options and leaves, right? So in fact, you're making actually a case for corporate governance even stronger, that maybe we need to hold managers accountable for what happens to the company. Rather than tying their compensation, maybe we need to hold back on that option. In fact, there are proposals that when you get options as a company or restricted stock, that be held in an account for 5 years after you leave before it actually gets paid out to you. And you can see why, right? Because if you've done something really catastrophic that's not going to show up till next year or 2 years from now, it gives me a chance. So maybe we can start talking about what the right way to frame these compensation contracts is, so that managers are not induced to do really stupid things and create large costs for companies and then collect their money and leave. Because I think that is a real problem in some companies. Any other questions? So I'm not arguing that markets are perfect. I'm not even arguing that they're good. I'm just saying they're better than the next best alternative for me, which is accounting earnings or market share or any of those other metrics. If you don't agree with that, think about that other metric, put it through the test of everything that can go wrong if you focus on that metric, because I guarantee you over time, everything that can go wrong will go wrong. It's the nature of these objectives. The weakest links are always going to get tested. So let's pull this all together. We've talked about lots of different things in this process, about maximizing value, maximizing prices, maximizing earnings. So I'm going to list out potentially objectives that you can place on a firm, on the management of the firm, and you tell me, and you can pick, you don't even have to tell me, you can pick what objective you think makes sense given everything we've talked about. You can just maximize stock price with no constraints, in which case you live in the utopian world, you're okay with all those costs. You can maximize stock price with constraints on being a good corporate citizen. And I'll let you define the word good, because you have to decide. Now, basically that means that there will be things you can do legally that you don't do, because if you did them, you'd be viewed as potentially an indifferent or a bad corporate citizen. Maximize stockholder wealth. What's the distinction between stock price and stockholder wealth? When I use stock price, what am I saying about markets? That I generally trust markets. If you don't trust markets, you would say, the stock price thing is too dangerous. Maximize stockholder wealth with good... So basically it's very similar to B, but now rather than focusing on the price, you say, I'm going to do the right thing for the value of the firm and hope the price catches up with me, because markets can be wrong. Maximize accounting earnings. That requires a special faith in accountants, which I don't have, but you might. Yeah? Maximize earnings growth. A lot of companies, growth becomes the name of the game. Maybe that's what you should be focusing on. Maximize market share, maximize revenues, maximize social good. I think it's an incredibly big challenge running a non-profit entity. My wife actually works with this organization that works with the homeless in New York. And she's on the board. And one of the things they had to write was a mission statement, which is essentially the objective for the entity. And their original mission statement was to help the homeless. And I said, this is not going to work. You know why? Because to help the homeless is a wish. It's not a mission statement. So basically, you got to be specific. Help the homeless how? By getting them housing, by providing, because in a sense, that you have limited resources. You have $500,000 or $1 million in budgets. You say, my job is to help the homeless. You can buy one big house, really a 5-bedroom mansion for one homeless guy. Technically, it is, so what is that? So in a sense, without a mission statement, you can't make decisions. So if you think this is just for for-profit entities, this is true for any entity. You need an objective. The advantage that for-profit entities have is they can state the objective in terms of profits and value. But if you're a non-profit, your objective has to be stated in something more diffuse. But even there, you've got to be pretty directed in that objective. Otherwise, it's going to be almost impossible to make decisions within that entity. In healthcare, this is often a big problem because half the hospitals in the US are non-profit, half are for-profit. And part of the reason healthcare is a mess is because if you're a non-profit hospital, it's not at all clear what your objective is. So, depending on who's making the decision, so that emergency room admissions nurse might be the one deciding what your mission looks like. And that's a very bad place to be if you're any kind of entity. So this push towards an objective is not just for for-profits, it's for any entity. You need an end game in order to be able to decide how to allocate scarce resources among competing users. So I'll let you think about this because, as I said, I don't want to impose my answer on you. But here's the way when I look at that list, it plays out when I look at a company. If you're a publicly traded company in a reasonably efficient market, I would say US, UK, much of Europe, I would call it reasonably efficient. I'm okay with you maximizing stock price. Right? But if that's only if bondholders are protected. So if lenders are protected. If bondholders are not protected, then you might, and markets are not efficient, maximizing stock prices might start to break down. So if you're in Eastern Europe running a business, should I maximize stock prices? My instinct is be careful, because what you might do in a very illiquid market to increase your stock prices might not be compatible with what you should be doing as a company. And if your bondholders are not protected as well, then I'd say rather than maximize stockholder wealth, maybe you should maximize value. So essentially, as each assumption falls, I've got to start broadening my assumption. So it's easiest to do corporate finance if markets are efficient and bondholders are protected. Unfortunately, we don't get to pick and choose. As we go global, we look at companies in India and Indonesia and Brazil and Peru. You're going to find yourself having to look at the environment before you decide what objective to give your CEO. It's extraordinary. I see people carrying corporate finance books written primarily in the US to Lithuania and telling the CEO, which maximize stock price, says that in chapter 2. You're a Lithuanian company, what do you do to maximize stock prices? You probably don't even want to see what I do to maximize stock prices. I could increase your stock price, but in horrible ways in terms of what I'm doing to the company. So it's not as black and white as it looks in most books. So when we talk about maximizing value, that objective always holds, but how it plays out in a company will depend on what you believe about markets and whether they're efficient or not, and what you believe about lenders and bondholders to the company. Okay. Any questions on the objective in corporate finance? So now we're going to start on the meat and potatoes of corporate finance. So if you're a fuzzy person, up till now it's looked really fuzzy, saying this is good, corporate finance is just like corporate strategy. We're talking and talking and talking, nothing's happening, That's going to very quickly end. So now we're going to enter into periods you have to start to grapple with things that you came to grapple with in business school. Question back there. Yep, go ahead. Okay, that's actually a very good question. The question is, when you talk about maximizing value, what's the time period? I'm going to give you an extreme answer. When the other class I teach is valuation. Now, the value of a business is present value of its cash flows over how long a period? Forever. I think in forever terms. I know that sounds incredibly impractical, but basically forever means that if you give me a 50-year project that adds more value than a 5-year project, if your objective is to maximize value, I want you to take the 50-year project. Now the problem is, how do I make you as a manager do it if your compensation is tied to earnings next year? That's why compensation systems matter, because if I compensate you based on earnings next year and tell you to be long-term, you're not going to do it. So as we talk about investments, we're going to come back and circle back about how we create compensation systems. It's something we've been struggling with for 30 years. We thought we'd solve the puzzle by giving options to managers. So that makes them think like equity investors. You know what the problem with the options is? Think about foundations of finance. As risk increases, what happens to the value of an option? It's the only financial asset where the value goes up as risk goes up. You see what I've done? I've given you equity, but I've given you equity which actually increases in value as risk goes up. You're going to take a lot more risk. You might actually find a risky bad project that makes you better off and makes me worse off. In fact, we're going to look at you're saying that's weird, you can't do that. I can find you lots of bad risky projects. And as a person compensated with options, you're going to be tempted to take those projects because your option value goes up and I'm left holding the bag. Okay? So compensation clearly matters, but getting managers to think long term is the first problem. Getting markets to think long term is the second problem. So you take that great 50-year project, you tell markets you've taken a great 50-year project, there's no guarantee it's going to react the right way. So I think lots of pieces have to fall in. So there's an element of faith in this process. You sometimes have to do the right thing and hope it plays out in the market. And I trust markets enough to do it, but a lot of people don't. And that's, I think, potentially a quandary for a lot of managers. They know what they need to do, but they're worried if they do it that they will get punished by markets, even if it's not true, because they've been fed a lot of falsehoods about how markets behave. I'll give you one example. US companies are terrified of delusion. I call this the bogeyman in the closet. We talked about why they don't make rights issues. You know why they're terrified of delusion? Because they've been told by bankers that if you have delusion, you're going to get punished. There is absolutely no evidence behind that statement. But it's almost folk wisdom, right? If you do an acquisition and it's accretive rather than dilutive, it's a good acquisition, says who? I know all your consultants say it, but the market doesn't seem to believe it. McKinsey actually did a study of you know what accretive acquisitions are? That's when your earnings per share goes up after the acquisition. Dilutive acquisitions, your earnings per share goes down after the acquisition. And bankers say, oh, don't do a dilutive acquisition, it's horrible for you. McKinsey actually took accretive acquisitions and dilutive acquisitions, looked at the stock price reaction. We found actually accretive acquisitions did worse than dilutive acquisitions. But again, think of how much time people spend in accretion and dilution because they fear what markets will do when in fact the truth is very different. So as we go through this class, we'll come up to those things like dilution and accretion. If I get a chance, I will show you the evidence so you can see for yourself what markets actually do rather than what they're rumored to do. So now let's talk about the first part of the investment principle. The investment principle is all about finding returns that make finding investments that make a return that is greater than your minimum acceptable hurdle rate. For the next 6 or 7 sessions, that's all we're going to focus on is 2 words, hurdle rate. What do we mean by that? How do we come up with a hurdle rate for a project? We're going to try to come up with a benchmark for every project, a hurdle rate. This is the minimum rate of return you need to make for this project to be good. And if I were to structure it, here's how I'm going to write the hurdle rate. It's going to have a risk-free rate as a base. I shouldn't settle for less than the risk-free rate, plus a risk premium. So let me start with the easy proposition. If you have a risky project, your risk premium should be larger than if you have a safe project. Your hurdle rate should be the sum of the risk-free rate and the risk premium. Now, of course, the challenge we face, and this is why it's going to take us 6 sessions, is first we need to come up with a measure for risk. Right? Because without it, I can't come up with a number for the risk. So first we say, how do we measure risk? And that's going to take us on an excursion through risk and return models, through risk through whose eyes. So that's the first step. Second, once we measure the risk, we have to be able to convert that risk into a number. You know what I mean by number? 6% premium, 8% premium. So this entire discussion for the next 6 sessions is about measuring risk and converting that risk into a risk premium. So let's start with that first question. What is risk? I'm going to throw the question out to you because you've taken a foundations class, some of you have taken corporate finance classes, some of you have worked in corporate finance. Give me a good definition of risk. What is risk? Come on. Volatility. You've taken too many finance classes already, right? Yeah. Uncertainty. Okay. Volatility, uncertainty. If I ask you what's uncertainty, would you say it's risk? I mean, it would be one of those words that we bounce back and forth.
I would say it's your exposure to danger.
It's your exposure to bad things. That's actually actually, let's start there. For most of you, when you think about risk, your first reaction, that's a bad thing. It's my exposure. It's natural. Everybody, how many people complain of upside risk? Right? It's always the downside. So the reality is human nature, when we think about risk, we think about bad things happening. We think about the likelihood of bad things happening, which is connected to uncertainty. It's connected to volatility. But it's really the fact that bad things can happen. Exposure to danger. And if you use that definition, you want to add to that definition?
Yeah, I was going to say probability of failure and how much.
Which is bad things happening, right? So basically, but again, almost it's human nature when we think about risk to think about bad things happening. You know the problem with that definition is if risk is a bad thing, what should we do about it? We should make it go away. And how do you make it go away? By either not taking risk, or if you take risk, doing what? Going out and hedging the risk or getting rid of the risk. You've just made yourself a target for every person selling risk hedging products on the face of the earth. I'm going to come and sell you insurance, and I'm going to sell you puts, and I'm going to sell... Basically, because you see risk as a bad thing, you make it go away. Let me ask you a follow-up question. Think of any great company, and I'll let you in your mind decide what a great company is, and you can come up with a name. Think of how that company became great. Did it become great by avoiding taking risk, or by actually seeking out certain types of risk on which they had an advantage? To me, that's the essence of business, right? It's not to avoid risk, but it's to go out and take the right kind of risks. One of my books is actually called Strategic Risk-Taking. You know how much of a struggle it was for me to put the word strategic into the title? Right? And it's essentially about how risk management as practiced has become all about risk hedging. Almost every risk management book is about how do you make risk go away? Risk management at a bank, don't even talk to me about it. It's all about how do we make risk go away. Risk management is much broader. In fact, when I think about risk management, it's about putting risks into one of three buckets. And every business has to do it. The first bucket is risks that you want to pass through to your investors. We'll talk about this. A lot of risks that you as a company shouldn't even be dealing with. They go right through to your investors. They can take care of it, take care of themselves. The second bucket is of risks you should hedge. You should protect yourself against. And the third bucket is risks you should seek out because you actually have a differential, a competitive advantage in taking those risks. So I'm going to give you my favorite definition of risk, and it's several thousand years old. It's the Chinese symbol for crisis/risk. I also have to tell you that every time I put the symbol up, after the class I get 5 emails from Chinese saying, you got the wrong symbol. I've changed the symbol 10 times. I'm not changing it anymore. You guys as Chinese need to get this nailed down. You got like 16 different versions of it floating around. So, yesterday I get this is not risk, it's big danger. I said, who cares? I have stopped caring. So I'm going to use this as a Chinese symbol for risk. And the Chinese symbol for risk is actually a combination of two symbols. Danger plus opportunity. So you got half the risk part. Risk is a combination of danger and opportunity. You know why I like this definition? It locks them at the hip. It says, if you want one, you got to live with the other. Who amongst us doesn't want opportunity? We all want to make 70% returns, right? What does this definition remind you of? If you want to make 70% returns, be willing to live with a lot of danger. Oh, you don't like danger? Don't ask for 70% returns. Think of how many mistakes in investing, how many investing scams could be avoided if we remembered this definition. I'll give you one of my favorite ones. Anybody here from Orange County, California? I love the place. It's always sunny. It's Disneyland right there. But one of the wealthiest counties in the US, 1992, declares bankruptcy. You know why? Because the treasurer of the county decided to take the county's pension fund and invest a third of the pension fund on interest rate derivatives in Germany. Don't even ask me what he was trying to do, but he was betting on German interest rates going up or down, and he lost big time. He lost a third. Huge scandal. He's on 60 Minutes. His name is I don't know whether he's still alive, Robert Citron. Citron, get it? Is that his real name? I don't think so. No, but then again, nobody in Southern California uses their real name anymore. So this Orange County, Robert Citron, it sounds like Wolf Blitzer. Come on. That guy's name is not Wolf Blitzer. Okay? It's probably James Standish, But Wolf Blitzer sounds so much, defense correspondent for CNN, right? So Robert Citrin. So let's concede his name as made up or real, Robert. And he was being interviewed by Mike Wallace, one of the great interviewers of all time on 60 Minutes. So here's how the interview goes. Mike Wallace asked Robert Citrin, Mr. Citrin, why would you take pension fund money that's supposed to be invested in safe things and speculate on German interest rates with it? And here's what Robert Citrin says. Because Charlie Clough told me I could make 15% with no risk. What's your reaction? Is who the hell is Charlie Clough, and why is he telling you these things? Charlie Clough was the market strategist at Merrill Lynch. In fact, that's part of the reason Merrill Lynch was actually a co-defendant in the lawsuits that came out of it. Now, there's no way Charlie Clough would have said this. You know why? Because I know market strategists. Have you ever heard a market strategist talk? They're incredibly slippery people. They're incapable of making a direct statement. After about 30 minutes of listening to a market strategy, you come out of the room and say, what did he say again? Did he say stocks would go up? I think he did. He said he'd go down? Yeah, I think he did that too. Market strategists are like, basically they're all over the place. So, but let's assume Charlie Clough, in a moment of honesty or when he was drunk, did say this. You could make 15%. Let's return to the interview. Because Charlie Clough told me I could make 15% with no risk, and I'm not a finance person. What's your job again? You're the treasurer of a county. I must have been mistaken. I thought that was some kind of a finance job. But it turned out to be an elected job. He was a very good politician. But let me ask you a question. Do you need to be a finance person to know that if somebody walks up and says, you can make 15% with no risk, that they're lying? In fact, if you think you can make 15% with no risk, you probably also think that Rolex you bought last week on Canal Street is really a Rolex. It was $40. And it says ROLECKS. Sometimes, for $40, the spelling doesn't go. You pay $40 for a Rolex, it's not a Rolex. If you're making 15% on an investment, it is a risky investment. But this is played out every decade. You have you take almost every big investment scam. At the core of the scam is you're being promised a high return with no risk, and you so want it to be true that you're willing to kind of shut your eyes to the fact that there is risk. So the essence to me of risk and return in finance is to measure the danger in an investment. And remember, in finance, we're not bungee jumpers. We don't expose ourselves to risk for the sake of risk and ask, how much opportunity am I getting in return for the danger? And if you get the trade-off right, you're making a good investment. And that's the challenge. How do we measure the danger in investment and bring it into a return that we need to make, opportunity we need to have to compensate for covering that danger? So I'm going to lay out what I would like a good risk and return model to do. So think of this as an idealistic world. You want to develop a good risk and return model. Here are 5 things I'd like a good risk and return model to do. First, I'd like it to come up with a measure of risk that cuts across asset classes. So if you give me a measure of risk, I want it to work with stocks, I want it to work with bonds, real estate. You give any investment, I should be able to measure risk with that risk measure. Second, it should tell me very clearly what types of risk I get rewarded for and what types of risk I will not get rewarded for. That sounds like a crazy thing. You're saying, if I take risk, why shouldn't I get rewarded? Because some of the risk that you took was your own fault, right? So if you decide to live across a 6-lane highway from a brokerage house, and every morning at 8 o'clock get up and run across the 6 lanes to the brokerage house to trade your stocks, and you say, you know what, I'm exposing myself to immense amounts of risk every day. Don't expect to get rewarded for that risk. You're going to see that this line between risk you get rewarded for and risk you don't is actually one of those central lines in finance. And that line is going to take us some time to draw because not all risk gets rewarded. Third, I need you to, if it's a good risk and return model and you give me a risk measure for a company, I want it to be self-standing. You know what I mean by self-standing? By looking at the number, I should be able to tell you whether this company is a risky, safe, or an average company. That's not going to work with standard deviation, right? If I told you the standard deviation in IBM is 36%, you're saying, okay, now what? 36 a high number, an average number, a low number, standard. So I'd like a risk measure that if I gave you the number, you're set. You said that's a risky company or that's a safe company. I'd like the risk and return model to then take that risk measure and convert it into a percentage return. Why? Because that's what a hurdle rate is. It tells me what I need to make. And finally, this is an unpleasant requirement. I want this model to actually work. I wish that were not required because I could construct all kinds of great models. But to me, those are the 5 things I would like in a risk and return model. So you ready? We're going to do a very quick derivation of the CAPM in 8 minutes. That's about all I need for that. That's all I know about the CAPM. Beyond 8 minutes, I'm kind of puffing air. So let's start off with how the oldest risk and return model in finance works. So this is the birth of finance, 1964, the capital asset pricing model. It starts off by measuring risk as the deviation of actual returns around an expected return. Let me restate that again. In the CAPM, we defined risk as the variance of actual returns around an expected return. Let me give you 4 examples of investments so you can see this play out. Let's assume you have a 1-year time horizon and you buy a 1-year US T-bill. And let's for the moment assume that there is no default risk in the US Treasury. So right now, a 1-year T-bill is trading at about 0.4%. So you buy the T-bill, you're being promised 0.4%. It's a 1-year T-bill. 1 year from now, I come and knock on your door. Ask you, what did you make on this T-bill? What's your answer going to be? There's no default risk. It was a 1-year T-bill. It expired at the time that I knocked on your door. You're going to make 0.4%. This is a riskless investment because 100% of the time, your actual return is equal to your expected return. Now let's move one step up the ladder. You still have a 1-year time horizon. You buy a 10-year T-bond. At the end of the year, I come and knock on your door. It's a 10-year T-bond. What part of your return is guaranteed? What can you count on? You're going to get the coupon of about 2.5%. What's not under your control? There's 9 years left on the bond. If interest rates have gone up between now and a year from now, you could have actually seen the bond price drop. If they've gone down, it could go up. So there's a price appreciation portion in there that is not guaranteed. A 10-year T-bond is not risk-free if you have a 1-year time horizon. Already we're starting to lay the foundations. When I ask you what a risk-free rate is, before you answer it, what do you need to ask me? Over what time horizon? There is no such thing as a risk-free rate. The 1-year time horizon, a 10-year T-bond is not risk-free. Let's move one step further up the ladder. You decide to buy Con Ed. It's a regulated utility, Stockholder. Pays a solid dividend, $2.73, which is about a 5% dividend yield. So you buy the stock. A year from now, I come and say, what did you make on the stock? First, the dividend, but is it guaranteed? Now, unlike a coupon, it's not guaranteed. It's promised. And generally, most of the time, you're going to get it, but hopefully you got the dividend. And the price itself could go up or down, but it's not going to move immensely because it's a regulated utility. It's not like the bottom is going to fall out and terrible things are going to happen. So you might be up 10% or down 10%. So this is a riskier investment than the T-bond, which was riskier than the T-bill. Finally, let's take the Snap IPO that happens a week from now. You make that your 1-year investment. Why are you doing it? Because you expect to make a high return. Let's say you expect to make an 18% return or a 15% return. A year from now, I come and knock on your door. If you were lucky, what might have happened? This could have behaved like Facebook did or Tesla did, and the stock would be up 80% or 100%. If you're unlucky, what could have happened? The stock could drop out and drop 50 or 60%. That's an investment that's even riskier because what can happen actually is much more different than your expected return. T-bill, T-bond, Con Ed, Snap. In every one of these cases, though, when I talked about risk, the risk was always in what happens next year. I'm going to state something that's going to sound incredibly stupid, but hang in there with me. There is no risk in the past. Risk is always in the future. There's no risk in the past because we know exactly how we got to where we are today. Risk is always in the future. You say, why state the obvious? Here's why. If I ask you how risky Con Ed is, what are you trained to do after finance class? You run quickly to the Bloomberg, you check the risk measures. But all those risk measures come from where? From looking at the past. This is a conundrum we're going to face all the way through this class. Is all our measures of risk come from looking at the past. All our worries about risk are in the future. And you can already see the disconnect that can sometimes happen if your past is going to be very different from your future. We'll talk about ways of dealing with it. There's really no choice. It's not like you can get risk measures in the future. But when we think about risk, that's what we're thinking about. So let me close with a challenge here. The CAPM operates in what's called a mean variance environment. It sounds fancy, but in the CAPM world, if you have two investments with the same standard deviation, the same expected return, you're supposed to be indifferent between the two investments. So if you have a 10% expected return and a 20% standard deviation to investments, in a mean variance world, you should be saying, oh, they're equivalent. Let's see if that is true. Let's assume you have two investments. They have the same expected return and the same standard deviation. So if you lived in a mean variance world, you'd be indifferent between those two investments. But let me add a couple of additional facts about these investments, and you tell me whether they might change your decision on the investment. Let's assume that investment A offers you a very tiny possibility of quadrupling your return, but the best possible payoff you can make on investment B is 60%. That's already embedded in your expected return. There are other things that make up for it, but there's this very small chance you could quadruple your money on investment A. But the best you can do on investment B is make a 60% return. So I'm going to go through the choices. Let's see with the first one. How many of you would still be indifferent between A and B? This is only one person. This is really bad news for the CAPM, right? Because what does the CAPM assume? We live in a mean variance framework. So it's already unrealistic. Let's set it to the side. How many of you would prefer A because of that quadrupling of your money? This is called preference for skewness. Sounds fancy, but you want that big positive payoff. And let's face it, I don't know how many of you go in and buy those lottery tickets. You don't have to admit to it if you do. The preference for payoffs is what, we know the expected return on a lottery ticket is negative because the laws in most states say 30%, 40% of the money has to go into education. I don't know where it ends up going, but basically you start off with an expected, but we're okay with it because it's the one chance in your life to put in $1 and hope to make 30 million or 50 million. We know investors value skewness, and in the CAPM, we act like we don't care. In fact, what if I added another possibility that you could lose 100% of your money in company A, but the worst you can do in company B is lose 50%. Could that affect your decision as well? Yeah, because some of us worry about downside. In fact, if you think about distributions, when you look at investment A, it's got fat-tail distributions. Basically, bad things can happen in both directions. As investors, we don't like that. So when we start off on Monday, we're going to kind of expand on this discussion and talk about how to come up with a way of measuring risk given the assumptions we're making along the way. The Armstrong World, I think was the name of the company.
I have a question about the last point.
Right.
Because if I remember Silver's class correctly, he made a similar point, but then would say you would arbitrage.
No, that's a different point. You can't arbitrage skewness and kurtosis, right?
But wouldn't ultimately, they would have to be priced.
And that's what that'll show up as is you might actually find that in stocks with high skewness, like Snap, you might settle for a much lower so if I graph expected return against standard deviation on a company like Snap, you might settle for a lower expected return than you would normally demand on a typical investment with that standard deviation. So it might be a reason why small cap stocks, for instance, earn more than the CAPM suggests because you have a much greater chance of that skewness. So maybe investors are not being irrational or inefficient in pricing small cap stocks, they're just pricing in skewness. So it might help explain some of those systematic pricings that we see. Low price to book stocks earn higher returns. Low price to book stocks also tend to be stocks in distress. Potentially if they recover, you could make 800, 900,000% returns. Maybe what you're capturing is a perfect. No, it's not guaranteed that it explains it, but it opens the door to, before we decide markets are inefficient, that small cap stocks are being mispriced, maybe we should look at the possibility that our assumptions are misspecified. that we're acting like we live in a mean variance world, but it's absolutely clear that very few people do. In fact, almost every study, behavioral study that looks at how investors behave, concludes they don't live in a mean variance world. Most of the time, we say it's close enough of an approximation. I'll tell you when it starts to work in your favor. As you start to create portfolios of stocks, the skewness starts to get less, right? So a small stock, an individual small stock has huge skewness, but a portfolio of small stocks has much less skewness, right? Because they don't all go up 400% at the same time. And that's when you could argue maybe mean variance is close enough to the truth with portfolios that we can assume that the CAPM works. And that's what we often stand on, is on a portfolio basis, you don't get big skewness or big kurtosis, so therefore investors can be assumed to act like they're in a mean variance world. Mm-hmm. Hi, how are you? About not being on the... I'm trying to... It won't let me add a .nyu.edu email. Do you have a Stern email? The email that you sent had .ny. You have a Stern email in there too?
I think because I registered using the same...
Okay, I'll go in and physically add it. Shouldn't be happening. Something's going on. I'd also checked registration, because if you're registered, because I just use the Google Mail alias that they give me for the people registered in the class. So if you're registered, you should be getting the email. So I'd go up and make sure that everything's okay with your registration. Just tell them you're not getting the emails from the Google Mail. Right. Why is that happening? Make them check the registration to make sure your name is on the list. I'm sorry? Sixth floor, the people with registration.
This building?
Yeah.
Oh, okay.
In the KMAC building.
Okay.
Yeah.
Thank you.
Mm-hmm. Hi, how are you?
I wanted to talk to you a little bit about choosing Alibaba as my company.
Okay.
Is it no problem at all?
No.
Okay. All right. Do you think that's going to be more challenging because it's...
No, it's a fun company to do. It's a company that you're going to find that Jack Ma's company is going to do whatever he wants.
Right.
But you knew that walking in, right?
Right.
And it's going to show up in good ways and bad ways. He does
Okay.
things quickly, and he can move into new markets. He can make decisions. He doesn't have to worry about consulting anybody. It'll show up in bad ways. Sometimes he's going to act on impulse. Why did you do that?
Okay. All right.
You might know the homework you'll have to do is understanding the Chinese online retail.